VeChain are effectively in the business of supplying data to companies and other organizations, and because VeChain work in the realm of supply chain management, that means that one of VeChain's largest sources of business is the trucking industry. And let me tell you guys right now that trucking is an industry which is not only massively overlooked, but it's also extremely stable and is therefore a potentially very lucrative source of regular trade and income for VeChain. Now, the pandemic has brought around a lot of conversation about which industries are essential and which are non-essential, and trucking is an industry which is about as essential as they get. Without trucking in the United States, food stores would begin to run out within 72 hours, gas stations would sell out of fuel within 2 days, and ATMs, which are like the veins of the cash-based economy, would run dry within a day or two. And the reason as to why all of this information is so relevant to a VeChain price prediction and the value of VET is because in the long term the market value of VET will reflect the performance of VeChain as a platform, and therefore any diligent investor who owns or is considering owning VET should be paying a lot of attention to the various sources of potential growth. And in this analysis I'm going to be focusing on one of the largest and most overlooked sources of growth, which is of course the trucking industry. Now, trucking is part of the logistics industry and is a part of the supply chains of millions of businesses in the USA and around the world, and in almost every one of these cases trucking is essential. And what this means is that I can fairly reliably say that trucking will still be here in 5 or 10 years' time. Now, the technology used in the industry in terms of driverless vehicles or artificial intelligence assistance may have changed a lot by then and is in fact fairly likely to change, but the actual demand for the transportation of physical goods from one part of the country to another is something which isn't going anywhere. And furthermore, the total level of demand is fairly consistent and reliable. It's also forecasted to grow fairly substantially over the coming years as well. And when I'm analyzing any prospective investment, I'm really looking for sources of growth and sources of revenue, which are predictable and which I can safely say are still going to be around in 5 years' time. Now, this may seem as if it's fueled by paranoia, and it may well be in part, but in today's rapidly innovating and disruptive landscape, things aren't the same as they used to be. Consumers are gaining and losing interest in certain industries and certain products faster than ever before, and therefore a stable source of income is also something to be valued more than before in my view. I'm not a fan of unnecessary complexity in any area of life, and that principle extends into the practice of investing, and I like to stick to Einstein's rule of being as simple as possible, but no simpler, and so I like simple yet effective direct calculations which focus on the fundamentals and nothing else. And the trucking industry, which we have to remember is just one part of the global logistics industry, in just one country, the USA, is worth $680 billion annually. Now, if VeChain can capture just 1/1000th of the revenue in this small part of the global logistics industry, just 0.1% by providing their services and generating a revenue in the form of VeThor payments, then that equates to a $680 million annual income for VeChain. And remember that the $680 million of annual income will manifest itself in the value of VET, not in the value of the actual VeChain platform. And one of the things which I like about VET, which isn't unique to VET but is something which is very rare in crypto, is that the gain in adoption and value of the platform in large part goes to the investors of the crypto, which is in this case VET. In many other crypto projects, whenever the platform does well, the majority of the gain is retained by the platform and very little, if any, goes to the investors. But in this case with VeChain, that's not the case, because when a potential customer signs up to use VeChain, they're required to pay for VeChain services in VeThor, and VeThor is generated in the form of a dividend by VET. Now, there are only 2 ways in which I can pay to use VeChain services. Number 1 is that I buy VeThor, which gives value to investors of VET, who receive a recurring dividend of VeThor, or I can buy my own VET and use my own VeThor, which again increases the demand for VET, which increases the value. And so every time VeChain land a new partner, each VET investor receives a benefit proportional to the size of their holding, which I think should be standard in crypto, but unfortunately it's actually quite rare. Anyway, getting back to the calculation, by capturing revenue equivalent to just 1/1000th of the trucking industry in the USA, not to mention the other parts of the logistics business in America and the rest of the industry all over the world, we're talking $680 million annually. Now, as mentioned before, this annual income isn't income for VeChain. A substantial portion goes to the investors of VET who sell their VeThor dividend, and so this $680 million will manifest itself in the value of VET, and in my opinion no reasonable asset sells for just 1 times its annual income. A stock with a dividend of $5 doesn't sell for $5, and an apartment which generates $10,000 worth of annual investment income won't sell for $10,000, it will sell for a lot more. And the multiple of income that an asset sells for is called a price-to-earnings ratio. In the stock market right now, a well-known index fund tracker like the S&P 500 has a price-to-earnings ratio of above 30 to 1, meaning that the price of each index fund share is above 30 times the rate of annual income. Now 30 times income is a fairly high figure to value an asset, and in the case of crypto being a fairly new and volatile industry, I think that by slashing the number in half and assigning a valuation of 15 times annual income to VeChain, or rather VET, we are more than compensating for any additional risk, especially when we consider that although VeChain is more risky, it also, in my opinion at least, has better prospects of value increases. And so if we multiply $680 million by the multiplier of 15, we're talking about a value of $9.75 billion for all of the VET in circulation right now, and that is about 3 times higher than the current market valuation. And remember that this is only considering a minuscule 0.1% share of just a fraction of the whole logistics industry, and just in the USA, albeit a fairly large and prosperous country. And so if VeChain can do the same thing worldwide, then we're talking gains of, in my opinion, 10 times a previous calculation. And so I really wouldn't be surprised to see VET selling for above 30 times its current market valuation. And if VeChain can do more than a 1,000th of the market share, then we're talking about gains potentially even higher. And by the way, I consider myself to be a realist, an investor who aspires towards rationality, and so I'm not going to say that this is guaranteed or inevitable or anything like that. In my view, looking at the data, I think that the calculations presented are realistic, and that gains of 30 to 1 in the value of VET over the coming years, equating to a market value of at least $1 per unit, are reasonable. But at the end of the day, this is just my opinion, and I could be wrong. And there is a risk that VeChain may not do so well, and that's something to be considered by every investor, as to whether they are willing to take that risk and potentially be wrong for the potential gains. Anyway, that's all for this video. If you enjoyed and found it to be useful, I want to ask you to subscribe to our channel to help us grow and allow me to spend more time researching and making these videos. Thanks for watching.